What if I told you that you could have monthly cash coming in from dividends? What if I told you that you have the ability to do this even if you don't know how to do it yet? In this video, I'm going to teach you about dividend investing. There are a lot of people that retire and live off their dividends. Most people retire at an older age, but they're great savers that do it at a much earlier age. You could retire by the age of 30 if you start young enough and invest enough. They slowly build a portfolio by investing consistently over a period of time. The more you put on a monthly basis, the faster you will get to your goal. Unfortunately, we aren't taught about money, never mind dividends. After buying a share or shares of a stock, you receive a dividend from the company, paying you a portion of profits from the company. Not all stocks offer this though. It depends on the company. For example, Tesla doesn't have a dividend, and it's considered one of the highest revered companies in the world, with a huge intrinsic value. There are also great companies to hold long term, but no dividends are paid. Some companies offer the dividend monthly, quarterly, semi-annually, and annually. The S&P 500 is a quarterly payout most of the time. As an example, we will use the S&P 500 to calculate possible scenarios. Welcome to Inspired Wallet's new videos are added every week. If you like educational videos on finance, then please subscribe and like. First, a little more on the S&P 500. The S&P 500 consists of the 500 of the top income companies in the USA. Ticker symbol in the US is VOO. In Canada, it's VFV. The ticker symbol is the name it's called on the stock market. It's usually 1 to 7 letters. This is done because some stocks have a really long name. It's just easier that way. Most of the gains in the S&P are from the top stocks in the fund. This includes companies that pay dividends and ones that don't. Yields are the percentages you get in return. So if the stock has a 10% yield, you will get 10% from the stock. You will get 10% of what the stock is worth every year paid in dividends. So if you've invested $100,000, you will get $10,000 a year, not including taxes. A 10% yield is considered risky or really high. The S&P 500 average yield is about 1.5%. That's much lower. This fund is considered the most trusted fund and has been for decades. As long as the yield isn't too high, often the stock grows in value as well. Dividend money needs to come from somewhere. This also adds another source of profits for you to sell. If and when you do sell, some of the profits from your dividends amount will go down, and possibly the yield on cost built up over time. Plus, unless you have it in a non-taxable account, you will need to pay tax on capital gains or shares. There are 2 different kinds of taxes, short-term and long-term. Normally, you need to pay tax on dividends unless you are in a tax-free account. Short-term gains are often higher and within the year, which means you buy and you sell within a year. Long-term taxes are often much less and sold after a year from the purchase date. If you don't sell any stocks that you buy, you won't need to worry about it. Capital gain taxes can be up to 50% in some places. It's pretty bad. With both reinvesting your dividends and the stock growth, with the power of compounding, it won't take too long to see the results. This is what Warren Buffett calls the 8th wonder of the world, compounding interest. Over time, you'll receive dividends that are reinvested into the same fund again and again. Over time, this is very powerful. Automatically reinvesting is also called dripping. Best way to explain this is with a few examples, using a site called MarketBeat. It helps calculate the compounding of interest every month on top of dividends. Let's say that we will buy $100 a month of the S&P 500. We will use the USA version, which has a ticker symbol of VOO. Since each share at the moment is over $400 US, $100 a month won't be enough to buy a whole share. It's about 1/4 or 0.25 of a share. This is why there's something called fractional shares, where we have the ability to buy a percentage of the share. This also works when the dividend is reinvested or dripped back in, because unless you have a lot of shares, chances are your dividend won't be high enough to buy a full share. It could take a while to build up enough cash to buy another one. But with fractional shares, this allows you to put it in right away, even though it's not a full share. The initial annual dividend yield for the S&P is 1.52%. This is how much you get paid. On $100 at 1.52% yield is $1.52. So over a year, you would get the $1.52 broken up into monthly, quarterly, semi-annually, or annually payouts. with an expected 3% dividend and share price raise a year. This is average. It's often different from year to year. This is also assuming that there isn't any tax, and there most likely will be. Now, with all that information, we can get to the good stuff, the projections. We will do 10, 20, 30, and 40-year projections with $100 a month reinvesting the dividends. This is an amount that a lot of people can do. If you can't do this, it's completely okay. It's more important to start investing than how much you start with. There isn't anyone saying that you can't invest more as time goes on in the future. This way is just a simple way to explain the nature of dividend investing. It shines some light on the power of compounding. Numbers might not be exact, but that's not really the point. But they're pretty close. Starting with 10 years. After 10 years, you can see an ending balance of $14,928.68, a total return of 23.34%, an average annual return of 2.12%, an annual dividend income of $228.50, a total dividend payout of $947.70, and the yield on cost is 1.84%. 20 years. After 20 years, as you can see, an ending balance is $38,018.72, a total return of 57.73%, an average annual return of 2.30%, an annual dividend income of $581.93, a total dividend payout of $4,668.34, and the yield on cost is 2.35%. 30 years. After 30 years, you can see an ending balance of $73,981.11, a total return of 104.91%, an average annual return of 2.42%, an annual dividend income of $1,132.40, a total dividend payout of $12,707.91, and the yield on cost is 3.05%. And finally, after 40 years, you can see an ending balance of $129,996.09, a total return of 170.24%, an average annual return of 2.52%, an annual dividend income of $1,989.76, a total dividend payout of $27,474.34, and the yield on cost is 4.02%. Looking on the charts, it's easy to see the longer invested, the larger each decade gets with compounding. Now that's pretty amazing that we can do this. It's not necessarily a perfect setup for most people, but the compounding effect is there to use as a tool. It's up to you how you use it. Imagine investing 1,000 in shares a month for 40 years. That's basically 2.5 shares of VOO a month. After 40 years, the ending balance would be $1.2 million. That's $1,299,960.92. Total return of 170.24%, an average annual return of 2.52%, an annual dividend income of $19,897.65, a total dividend payout of $274,743.35, and the yield on cost is 4.02%. Everyone needs different things in their life, so set it up for how you need it. This portfolio could be the fund that you use to put your kid through college or university, or the money you use to buy your dream home. None of this, of course, is financial advice, just a friendly video on finance from the perspective of inspired wallets. If you like this video, hit the like button, leave a comment, ring the bell for future notifications, and make sure to subscribe. Do you have a favorite dividend stock in your portfolio? Leave it in the comments below. Thank you for watching.